Money Radio for a really great future. We're talking real money.
So why has the stock market been so bloody resilient for the past, I don't know. Are we going on 20 years now that it's been pretty much resilient? That it's just, it has little times when it goes down, but big market declines, we haven't had a big protracted one since 2008. Why is the market so resilient in the face of all these scary things that have happened, from COVID to tariffs to wars and the like? What is the answer? I'm Don McDonald along with Tom Cock. And what are we doing? Well, we're talking real money with you on the Talking Real Money podcast. Glad you chose to be a part of it.
Yeah, this is a fascinating thing because, first of all, no one really knows why stock prices are going up, right? Unless you talk to the 65 million people that trade every day or whatever. That's some big number, right?
Because more people are buying stocks than are selling stocks.
That's my line. Then you always get mad at me for that one. That's silly. Well, it's kind of
true, though. It is absolutely true. That's the only thing we know for sure. It's going up because more people are excited about it than are fearful of it.
And yet the Wall Street Journal writes articles like this. A new generation of buy-the-dip investors is propping up the market, adding to the froth that's already on top of overpriced stock prices. Well,
why is that wrong? Because that sounds right. There's somebody's out there buying stuff.
Yeah, but is that because they're buying the dip? Is that because every 2 weeks they take money that goes in their 401k and they buy? Is that because they're so smart that they know when they're 25, you should just keep buying every few weeks because the market always goes up in the long haul? Well, nobody knows that. But they do talk a little bit. You mentioned an interesting period, 2008, because I went back and looked at the numbers. It's not pleasant. October 2007 to March 2009, pretty long period of time. That was a real bull market, and the market was down over, the S&P 500, down over 50% in that period of time. That is it's a deep
bear
decline, and it's
you said
long
bull
time.
Market.
Bear market. Bear market. Yeah.
Bear market.
Bear. Yeah.
Very, very berry.
Very berry. So in the article, they talk about the current crop of young investors have mostly known blue skies since they opened their first brokerage accounts. I couldn't agree more. You look at 2020, for example, down almost 30% stocks were in the spring, and then rebounded by the end of the year by like 70% from that low, right? 2022, same thing. You had a pretty sharp decline and then turn around, go right back up. This year, April, right? Remember we had the huge downturn when the tariffs were announced, whatever. And what's happened? Turned around and gone basically straight back up. So younger people, I think, haven't seen the damage of a real bear market, and that has allowed them to stay in it. My question is going to be, is when something really bad happens, and it will happen. I don't know when. I don't know why.
How do we define younger investors, though? Because
don't trust anyone under the age of 30, right? Isn't that what the line is? I don't know.
If we're talking younger, as in I don't really remember 2008, then we're talking so young that they under really 30. Don't have that much to invest.
That's a good point, by the way. Well, the other money is just sort of sitting there, right?
Yeah, and here's the thing is that sure there are people buying the dip because the dips have been small. Wait until the dip is big. Remember from people prior to 2000. People were doing the same thing. They were just they called it the new market paradigm. Remember back in the late 90s?
Oh yeah, sure.
Oh, it's different this time. It's not going to go down, and then it went down, and then it stayed down for a long. Really, 2000 to 2009 were pretty terrible.
It was awful. Again, if you just invested in large U.S. companies, you lost money for a decade. That's a long time.
And I think people forget that. And remember, this article also states that for 4 years after the market bottom in early 2009, money was still pouring out of the stock market.
I was just going to get to
that. Not pouring in to the stock market.
Billion.
So what happens when the news is bad for a protracted period, just like right now it's good, people will change their tune.
Yeah. You mentioned, 50 billion came out of U.S. equity funds in 2008. That's when a billion really meant something in 2008. And now, due to the recent market increase, according to Fidelity, there's 537,000 401k millionaires. And more people own stocks. This is it feels horribly naive to me. Feels like I have no idea what's next, but when I read stuff like this, it makes me extremely nervous because when you're buying the dip, are you buying the dip or are you a dip? You got to ask. When I read that, I was like, whoa, wait a minute. Am I the last guy on the line here? What should I be doing?
Let's talk about those. See, when we look at it in this way, it almost feels black and white. It's like, it's going to be great, it's going to be great, it's going to be great, and then it's suddenly not great, and then suddenly everybody's really negative and pessimistic for a long period of time. But the reality is, there is a middle ground that we keep forgetting about. Even though from 2000 to 2009, U.S. stocks declined in value, generally speaking, pretty much across the board. Particularly the S&P 500. It was down 10% over that period. Total. What saved you from that protracted, terrible market? What is the one thing that saved you from a high level of pain over that period?
Can I say gold or Bitcoin and not get thrown out of the recording? Or
no, you're going to get thrown out for those because they're the wrong answers.
I know. Diversification.
Yeah.
Right? Yeah.
Yeah.
Owning something other than those
If you'd
stocks.
owned international stocks, you would have had a nice steady about 7% per year.
People forget that.
In a global portfolio, globally balanced portfolio, a global equity portfolio. If you had bonds in there, the downturns would have been less painful. We don't know which is going to do what in the future, but we do know, based on what we've seen, that diversification, at least in the past, has bailed your tail out.
Yeah. And one of the things I like to tell people that have never faced a very difficult and protracted downturn is, in these great times, write down how great you feel. Because you may need to pull that piece of paper out of the drawer when the market takes the big you-know-what. And so if you haven't faced that bear market, that's difficult. I also worry about overconfidence. People are invested, I think, in few equities because those have only gone up. They don't realize how much risk they're taking to be in a concentrated portfolio. And by the way, the S&P 500 now has 3 stocks that make up 20% of the index. That just feels riskier than you-know-what to me. Really, that's very narrow, but I will give Pat Sweeney, our CEO, credit for this because in a recent meeting, everybody's talking about, hey, we've added these firms, market's going up, we've been adding assets, been great. And at the end of the meeting, Pat raised his hand and said, here's what you should be thinking about. What could happen next? Because bad times will come. I equate it to, wasn't there a thing in Game of Thrones called the winter is coming or something like the winter is coming?
That's the motto of the northern people is that winter is coming. And
I say it a lot at my house too. The thing is,
it's not coming here. Yeah, we're like Dorne here in Florida.
That's true. You are.
Yeah, it gets a little chilly, but it's not really winter.
That's about it. Yeah. So, okay. So, but how do you deal with winter? Well, same as the Northerners did. They had a plan for how they're going to deal with it, right? They didn't just show up one day and go, we got to stop those monsters from coming down here. They had an idea.
Bury your acorns.
You bury your acorns. Your risk return ratio, rather than just saying, well, I bought NVIDIA because it always goes up until it doesn't. And then you mentioned something pretty interesting that I think has been not in favor for a while, and those are called bonds. Nobody wants to own bonds anymore. I hate it.
Well, I want all of you, and because many of you I know are still in denial about the reality of markets, I want everybody who hasn't done this recently to go pull out your portfolio statements from your 401k, your brokerage account, your IRAs, whatever you have. I want you to pull those out when you get your next quarterly statement, lay them on the table, or pull them up online, and calculate the percentage of your portfolio that is in U.S. equities. And I'd be willing to bet that most of you have most, if not all, of your stocks invested in the United States, and most, if not all, of your portfolio invested in stocks in the United States.
Large stocks.
Large
Most
company
people-
stocks. But
Yeah,
even
most of
just United States. You're missing international because you've been saying to yourself, well, I'm owning the ones that go up. No,
Yeah.
gone up. Quit
Thank
with the future tense.
And here's another thing I suggest. This was from you several years ago. Take all those statements you just mentioned, total them all up, and think, oh, look at all this money I have. And then take 20% off the top. Not
Or
just
if
for
it's all
taxes.
U.S. equities, take 50% off the
Yeah,
top.
it's not all yours, by the way, until you sell it and have that in cash. Number two, it's not all yours anyway because you got this partner called the federal government that's going to want their piece of the profits
State too.
Yeah. So I think that is wise because you're feeling really great. Come back to reality a little bit. Have that plan. Know your risk-return ratio and own some of those bonds, those things that have been a little more stable in the long haul.
Wait a minute. They've been terrible lately. Why would I own
know.
bonds?
Exactly. And buy the things that have been terrible lately. Isn't that what Warren Buffett once said or something? I don't know.
Lately.
All
right.
Questions.
Let's do
Should we get to
questions.
them? Yeah.
Yeah.
Great.
Oh, yeah.
Thank
I
you
love
for sending them.
questions.
You can go to talkingrealmoney.com and send us more. You could do an audio one with Don. I liked your little last week, your little lecture about everybody should have a microphone now, and here's how to use the microphone. That was a great little audio lesson, Don McDonald's.
How to use your microphone.
How to be an announcer.
45-degree angle to your
I
mouth.
know.
Do
It's
not
great.
talk straight into it because that makes it go like that.
It's very helpful. Very helpful. Yeah, I loved it. So,
I moved my mic.
So if you don't know how to do your mic, go back and listen to that episode because Don will give you the audio lesson.
We help you with everything.
Everything. That's right. Coming up next week, how to
TV
make
shows, movie
the best
reviews.
grilled cheese sandwich ever, which I
By the way,
used
I got
last week.
forced to go. I got forced.
Uh-oh. What'd you go? What?
Well, see, every week now, because it's 100 degrees outside,
Yeah, you go
literally
do something
100
inside.
degrees, we
Yep.
need to do something to get out of
Yep.
the damned house. So the thing lately has been go to the movie theater.
Because it's cool.
Go to the movie because it's
Yep.
cool and it's entertaining. Well, okay, it's cool. I'm gonna. So we've been to the superhero movies because Debbie
How
will
was
not
Superman, by the way?
Debbie will not do horror. She will not
No.
do horror.
Nah, me either.
I will not do cartoons. I will not do animated. I will not do them. So that eliminates about 50 to 75% of the movies at the theaters right now. So we basically had the Avengers and Superman
And how was Superman? I'm seeing that's tomorrow.
and the Fantastic Four.
Yeah.
It was entertaining. I'm gonna.
Okay. I'm taking
gonna
my
go with
grandsons. They're going to love it. So whatever.
Yes, you're. It was entertaining.
All right. Yeah.
But the last 2 weeks, the choices have been really terrible.
What about the one where the guy always gets beat up? I love that one. What's that one called?
Guy always gets beat up.
Yeah.
What are you talking?
It's a second movie, second edition of it.
You're not talking about Naked Gun.
Nope.
No. Always beat up. Oh, no, Debbie won't watch that either. That's ultra violent. No,
Is
you're
it?
talking. Yeah, you're talking about Bryan Cranston.
Nope.
No.
Nope.
What movie were people?
I'm
always
going to
get
look it up. Wait for me. I'll tell you right now because I know where to go find it because I just saw it.
No, you don't.
Yeah, I do. I know where to
Rotten
go.
Tomatoes.
I got a better idea. Watch this. I'm going to be able to.
Nobody
it'll
2.
go-
There's that one.
Is that? I think that's it. Yeah, nobody.
Yeah,
that's the one.
I mean, not
yeah,
Brian.
yeah.
Bob Odenkirk. Bob Odenkirk. I meant Bob
Odenkirk.
Odenkirk.
Yeah, right. There you
Yeah,
go.
no,
I
it's
like the
super
first one.
violent. Did you watch the
I
trailer?
watched the first one. No, I watched
Super
the trailer.
violent. It was
Okay.
violent. She doesn't like
Okay.
violence. So that's off the list. So that
Funny,
leaves us.
though. Funny.
That left us the last 2
That's
weeks. It's
not a
basically
lot.
between Jurassic World, which we've decided not to see just because
Yeah.
it's so bad. I tried to convince her to go to Eddington. She said, "No, it sounds stupid."
I don't even know what that is. So
It's okay. Minor.
Okay.
It's okay. Yeah, I'm not going to go see How to Train Your Dragon or
no, I saw that
Smurfs.
already.
Ain't gonna see Smurfs. Not
No,
gonna
me
ever
either.
happen.
Me either.
Ever in my life. So we were stuck 2 weeks ago with Naked Gun.
Which we both
No!
agreed was lame. It wasn't very good.
It was terrible.
don't know.
I went like this.
What is it on Rotten Tomatoes?
Like it's really got really great reviews on Rotten Tomatoes, but about 6 times I did this, I went, huh. That was it. I went, huh.
Mildly.
Just like that.
That's all you do with my joke, so you're hard on me, too, so I get it.
And then last Sunday, we were
You didn't even like the UCLA joke?
All
right, that's okay.
Yeah. Oh, yeah. I see it every day. Yeah. Mm-hmm. Dad jokes. Anyway.
Yeah.
So we were left with one movie. One.
Okay,
there
what
were
was it?
no other choices. None.
Yeah?
Freakier Friday.
Oh, no.
And it's 74% fresh.
Oh, good Lord.
No.
It's
No.
It's more stale than a week-old loaf of bread, man. Come on.
And here's the thing. Because now, instead of it just being 2 people switching, because it's like 2 people who switch age.
Yeah.
It's 4 people.
Oh, God.
And throughout the movie, Debbie's leaning over going, now who switched with who?
I got to have an interpreter here to figure this out.
So
that's sad.
I think all of the best stuff
now.
Well, this week we have Nobody 2. That's it.
Oh, that's right. Which she said you
and so I hopefully there's nothing left. Oh wait, there's Americana. What is that one? Let's see what that is.
I saw the name, but I don't know what that is. So
I don't know what that is, but it's probably going to be bad. Just a guess. This is like dead
film.
Time. This is really dead.
They don't do anything
time
now, right? Well,
in the
people are outside. It turns
awful.
out, unless you're in Central Florida. Yeah.
So the best entertainment, I'm telling you, it's on streaming television.
Oh yeah,
that's
there's
where
a lot
the
there.
best stuff is. So glad I have my Apple Vision Pro, so I can watch like stuff in a giant movie theater without being anywhere. And
all right, let's ask a few questions here. We got the movie thing figured out.
How did we get on that?
I don't know. I can't remember. Don and Tom, I like you guys. Thank you. And your overall message of buy and hold, don't time the market. I have a bone to pick, though. This is from John, by the way, in Doylestown, Pennsylvania. You tell investors to rebalance once or twice a year by the calendar date.
Yeah.
I don't think we've done that, but okay.
Well, we kind of do. We say just, every year or so check.
It's simple. Yeah, if you're going to do it simple.
Just to force you to do it, because most people won't do it at all.
Most people don't, yeah.
That's the only reason is for sheer simplicity.
Yeah, I agree. But you're missing out on gains by rebalancing this way. Opportunistic rebalancing.
I get it.
Is more work, but it pays off. Say you're 60-40. You have 10% market drop. That's going to cause your ratio to be out of balance with stocks lower, bonds higher. If you rebalance at this time, buying the dip in the market will create nice gains as the market goes up. Rebalance again when the market reaches previous highs. You can set up 60-day limit orders with Vanguard, only transpire. I get it. Okay. And by the way, we did that this spring with a lot of our clients, right? We sold bonds and bought stocks. Sure.
And we've said that before. That other one was kind of, I think, out of context. The optimal way to do it is to do it when you have a big change in your portfolio.
Correct.
Whenever.
You get out of sync. Yeah, or your ratios aren't correct. You could use a 5% band. You could use a 10 one, right? I mean, depending on what's happened in those two places. So, yes, rebalancing.
But most people won't do that.
No, they won't. And it's counterintuitive, too. You got to sell the thing that's gone up and buy the thing that's gone down. It's not easy.
A lot of work to follow it.
It's a lot of work, yeah. So, no, we don't disagree with you there. Benjamin writes us from Kindred, North Dakota. Apparently out of Kindred Souls listening to this podcast. Hello. In my investments, I will rebalance by selling the winners and buying the losers to get back to the right allocation. That's correct. However, if I need some money for my brokerage account, should I be selling the winners or should I be selling ETFs that haven't gone up as much as to minimize the amount of long-term capital gains? Thanks for the help, Ben.
A little tax planning can go a long way.
There isn't a right or wrong
that there should be an element of tax planning involved. It's nothing is black and white, which is why we believe you can sure as heck get away without having an advisor when you're in accumulation.
Yeah.
But when you get to distribution, decumulation, that's when it's really important to have somebody helping you make these decisions based on all of the various factors that you're going to forget to take into account or have a hard time putting into play.
Or just doing it. I mean, because as you just said, it's April and the stocks have gone down and they're going to keep going down. And we're going to say you got to sell the bonds and buy the stocks. And you're going to say, are you nuts? Seen it once, seen it 100 times. Great question. Ryan from Walworth, Wisconsin.
That's right down the street from Walgreens and over around the corner from Woolworth.
It's Woolworth. Maybe it's supposed to be Woolworth. I don't know. Ryan, thank you for writing. Hi, Don and Tom. Your podcast is awesome, and I've learned a lot of info from both of you. Well, I think we should just end the show right there. What do you think? I think that's probably good enough. Okay. I'm debating between a couple of international funds in my IRA. I've heard you talk about AVDE. That's the Avantis developed equity market. More often from Avantis, but one that's missing emerging markets. Yeah, that's just developed markets, right? International.
Wait, AVDE?
AVDE has no emerging in it. I think that's correct. The Avantis fund that has both developed and emerging is AVNM, which we mentioned in a recent podcast.
Yeah, we just mentioned AVNM.
Yeah, that has all international stocks, some developed markets and some developing or emerging markets, the Brazils and Indias, China, et cetera. But it's definitely on the higher side of fees. 0.031 fees are way higher than VXUS from Vanguard and even AVDE.
Mm-hmm.
Yep. I see.
We agree with you, but that's because it's a more expensive fund to run and it's a smaller fund, much smaller.
Oh, yeah. It says, I did see AVNM as a fund of funds, whereas AVDE seems to own 3,500 stocks. Does Dimensional offer an international that has an international market along with emerging markets for cheaper or about the same? I forgot to look this up. But I imagine the Dimensional is an all international exchange-traded fund. Sure.
Oh, yeah, I'm sure they do.
Which one do you think is better between Avantis and Dimensional? This is not a debate we can answer, but we'll talk about why that's true in just a moment. But Dimensional's all international equity fund is.
I'm looking.
That's where you come in, right there.
I didn't have a warning. International. That's their.
They don't have one.
I'm looking for an ETF.
Looking for funds in all the wrong places.
I'm going to have to look somewhere else because I can't find one. Dimensional.
I'd be surprised if they didn't, but I've been surprised before. But
they have a fund.
Yeah, while Don's looking, the difference between Avantis and Dimensional, there are differences. Dimensional generally holds more securities than Avantis. Dimensional generally does not tilt quite as much as Avantis would in terms of the small value and other factors, right? And in some cases, Dimensional can be a bit cheaper. Now, we do not know going into the future which of the fund families will have better performance. I think it'll depend on how the markets act, right? I mean, sometimes small value, momentum, those things have a greater impact on market prices, or the other way does. So
okay. So it's the same as with their mutual funds. It's the core equity funds.
So they have an international core equity fund.
Yeah, they have an international core equity and an international core equity 2.
Which generally has a greater leaning to small and to value.
Yes, the core equity 2 is greater small value and therefore a little bit more expensive, but still pretty darn cheap compared to Avantis.
Yeah, when you say way at 0. How much is it?
0.23 for equity 2 and 0.18 for equity 1, core equity 1.
And then the Avantis at 0.3. I will tell you this. As someone who's seen a lot of the prices of these things for a long period of time, 0.3, while it feels high because Vanguard has funds that are, 1/10 of that, is really not that high. Really not that high. Yeah. When it comes to being globally invested in all those stocks, pretty doggone cheap. And my take is, I don't know that change between 0.3 and 0.2, just generally, is going to make that much a difference in your portfolio over the long haul. But what's your take on just generally Avantis versus Dimensional? If you had to decide on that debate,
I don't have a preference.
Yeah, I think that's fair.
I really do not have a preference. I think they're so close as to be almost interchangeable, which is what makes them, by the way, having these two companies with very similar ETFs makes tax loss selling so easy, because if you have a loss in which you don't now, but you might someday in an Avantis fund, you can sell the Avantis fund, take the loss, book the loss, and immediately buy a very similar fund at Avantis, but it's not going to be considered substantially equal, so you avoid the wash sale rule.
I love that. That's a great strategy. You go back and forth between them. Yeah, makes sense. So you're right. Don't have that today, but you could have that in the future. So we favor both families. How's that?
Yeah, I like them both. I know I'm splitting the baby, but I don't prefer one over the other.
Yeah, I think that's fair. So there you go. There's your questions. There's your statements. There's your issues, all answered in one podcast.
By the way, I was just looking through, while I was on Rotten Tomatoes, I was looking at the...
We're back to this now again?
Oh, yeah. Well, because I couldn't avoid it. I was looking
at
the
one with the punching in it? How's that? How are the Rotten Tomatoes on that one?
The what?
With Odenkirk.
Oh, no reviews yet. So that's not a good sign.
Okay.
When you don't have reviews yet, that's not necessarily a good sign. No, I was looking at what has been the panned as the worst movie in the recent past.
Yeah,
and that's the new War of the Worlds.
Orson Welles did another film.
No. This is one where it's really it's made by Amazon and it's really awful. Oh, it's got 3% fresh.
Is there any movie that Amazon has made that's been good?
I don't know, but
is this going to be the whole Eisenhower-Nixon thing when they asked Eisenhower, can you tell us something good about the vice president? And he said, yeah, I can, but give me a while to think of something. I mean, this is ridiculous. Why are these people making films? Just show reruns of documentaries or something. I don't get that.
This is one where Ice Cube, which is really funny because the guy who's named after frozen water, sits in front of a computer screen. He's working for the government, and the whole movie is done through his computer screen, which is just a silly idea. But my question was, how is it 3% fresh when every review I've read is just horrible?
Must have one good review.
Like one review. Listen to this review. It says, it's bad. Really irredeemably bad. But the one positive review it got, I don't know if you should even call this positive, was from the reviewer at Entertainment Weekly who said, it's certainly stupid, but it's also a great deal of fun.
And I'm glad to see the revival, I believe, of Ice Cube's career because I haven't really followed it since the mid-1980s, right? So I'm happy for that.
Well, he's older.
Got work.
He's definitely older now.
Good that you got. We're sitting at a computer, I guess.
Sitting at a computer, and that's the whole movie.
That's great. Wow. Mm-hmm. There's one I don't have to watch. So
no way, not watching it.
Nope. Don't care what we get down to.
Apparently, for one person in America, it was a great deal of fun. One person. Yeah.
I'm glad they're entertained. So,
do we have anything else we need to cover? Any important
the only
movies?
other thing is, again, now we're getting ready to head into fall, right? Mm-hmm. Many of you put off all the painful money stuff because it's summer and, I'm out on a lake or I'm doing this with whatever, blah, blah, blah. I get that. Makes sense. Now, it's time to get serious. So get your finances in order. Is that too hard? Get your finances in order. Talk to an advisor. Get a plan. Review your portfolio. And guess what? You get the portfolio review and the discussion for free with no obligation.
And no pitch.
No pitch. You go to talkingrealmoney.com and click on Meet an Advisor. And yes, I'm taking meetings again because I'm on a break from my vacation schedule. So I'm.
Do you have another vacation schedule?
I don't want. I'm not even. You think I'm going to mention it to you of all people? That would be you. The last guy.
In a couple of weeks, I am going to take a Saturday off though and make Tom do it alone.
Kettle and pot and black and all that stuff.
I'm going to see my 89-year-old mother in the nursing home.
All right. I'm going to use that one next. So I'm going to try that. So.
You can't.
I can. Sure, why not?
You can't because she's gone.
Well, but you don't know that.
You're going to visit my 89-year-old mother in a nursing home?
That's good. I'm going to try that. Sure. I'm seeing it. Anyway, so yes, I'll be doing the program by myself, which I'm excited about.
All right. Go to talkingrealmoney.com for all kinds of cool stuff like meeting with an advisor or asking us questions or listening to podcasts or reading all kinds of stuff we wrote back in the days before we had to go through a compliance department that wasn't Tom.
Back in the days.
Because I haven't written anything. I haven't written anything since then.
Exactly.
But it's still good stuff. And thank you so much for being with us. Tell a friend or two or maybe a dozen if you have them. and keep listening to Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.